Nike stock just hit its lowest price in 11 years, and if you've spent any time in financial media over the last few weeks, you've heard the same take recycled over and over. The brand is tired, the product is stale, On Running and Hoka are eating their lunch. China is a disaster. Move on. But here's what I've noticed every time a dominant company trades at a decade low. Everyone has an opinion and almost nobody has actually done the work. So today, we're doing the work. Because buried inside what looks like a simple story of decline, there are some signals that the crowd isn't talking about. Signals that matter. And by the end of this video, you're going to have an opinion that's actually based on something. Not just whatever headline you scrolled past this morning. This is the pitch desk. Let's get into it. First, let's establish what actually happened because the scale of this matters. In November 2021, Nike stock hit an all-time high of $179 per share. The company was coming off a COVID-era demand surge. Their direct-to-consumer model was hailed as visionary, and China was their fastest-growing market. Everything looked good. Today, the stock trades around $43. That is a 75% decline from peak to today. You would have lost 3/4 of your money holding Nike through this period. To put that in perspective, Nike isn't a struggling startup. This is one of the most recognized brands on the planet, and the stock is back to where it was trading in 2017. That's nearly a decade of price appreciation, completely erased. So what happened? Because the answer to that question is actually more interesting than the number itself. To understand where Nike is today, you have to understand the decision that set all of this in motion. Around 2017, Nike began shifting away from their traditional wholesale model. The strategy was to sell directly to consumers through Nike's own apps, their own website, their own stores. Cut out the middleman, keep more margin, own the customer relationship. On paper, it sounds smart, but by 2020, the previous CEO, John Donahoe, went all in. Nike began pulling back from thousands of wholesale accounts, Foot Locker, Dick's Sporting Goods, independent retailers. These weren't just distribution partners. They were the physical touch points where consumers discovered new Nike product. Nike essentially handed that shelf space to their competitors, and their competitors took it. On Running moved in, Hoka moved in, brands that nobody was talking about in 2018 started showing up in the spots where Nike used to live. At the same time, Nike's own channels couldn't support the volume. They flooded their digital and direct stores with older, discounted product to move inventory. That discounting eroded the premium positioning that Nike had spent 4 decades building. The result? Revenue fell 10% in fiscal year 2025, Nike's worst annual decline in the modern era. Earnings dropped 44% year over year, and the stock reflected every bit of it. This wasn't bad luck. It was a strategic miscalculation at the highest level. Here's where the story changes. Elliott Hill, he spent 32 years at Nike, worked his way up from a sales intern in 1988, eventually running North America and international markets. He understood the wholesale relationships. He understood the retail partners. He understood the athlete and the sport are the center of everything Nike was built on. He retired in 2020, and then in October 2024, with things worse than ever and in need of a savior, the board called him back. Think about what that says. The Nike board looked at this company, a company that had spent 5 years trying to reinvent itself, and decided the best path forward was the man who spent 3 decades building it the first time. In his first earnings call, Hill said this: "The truth is, Nike's journey back to greatness has only just begun." That's not corporate spin. That's someone who knows exactly how deep the hole is and isn't pretending otherwise. His strategy is called Win Now. 5 pillars: culture, product, marketing, marketplace, and in-person experiences. The biggest shift is rebuilding the wholesale relationships that the previous regime walked away from. And in early results, that bet is paying off. Now here's the part that I think is genuinely underreported. When a stock drops 75%, you expect insiders to stay quiet. You expect executives to issue careful, measured statements about long-term value. What you don't expect is for them to put millions of their own money into the stock on the open market. That is exactly what has happened at Nike. In December 2025, Tim Cook, the CEO of Apple and Nike's lead independent board director, bought 50,000 shares of Nike stock in an open market transaction. Not options, not compensation, his own capital at $59 a share. Then the stock kept falling. After Nike's Q3 earnings in late March 2026, the stock dropped another 14% in a single day on weak China guidance. And what happened next? The insiders didn't retreat, they bought more. Tim Cook stepped back in and purchased another 25,000 shares at $42 a share. CEO Elliott Hill bought 23,660 more shares on April 13th, 2026, literally this week at $42.27. Director Robert Swan added 11,781 shares at $42.44. Director John Rogers bought 4,000 shares at $43. These are open market purchases, discretionary, each one filed with the SEC under Form 4, available for anyone to read. You can rationalize one insider buying, you can rationalize two, when the CEO, the lead director, and multiple board members are all putting their own money in at the same price. At the same time, after a 14% single day drop, that is not coincidence, that is conviction. And here's the thing, the insiders aren't buying on faith. The data is starting to turn. The running category, Nike's most competitive and most important performance segment, grew more than 20% globally for 2 consecutive quarters. That matters because running is where On Running and Hoka have been taking their share of the pie. Winning there is how Nike proves it can compete on performance again. North America wholesale revenue grew 11% in Q3. That's a direct result of Hill's strategy, rebuilding those retailer relationships and putting product back on the shelves where consumers actually shop. And perhaps most telling, in February 2026, every single Nike sales channel grew simultaneously for the first time in 2 years. Digital, stores, wholesale, all positive at the same time. That hasn't been true since before the decline started. Hill's own words on North America. It's driving a healthy, repeatable offense and showing us what winning looks like. It's a great signal for our future success in other geographies. The recovery isn't complete, but it's real. I guarantee most people watching this video have never heard this stat. Nike has raised its dividend for 24 consecutive years, every single year without exception, through the 2008 financial crisis, through a global pandemic, through the 75% stock collapse. Now, why does that matter? Because in the S&P 500, there is an elite group of companies called Dividend Aristocrats. The only requirement for membership is 25 consecutive years of dividend increases. Only 68 companies in the entire index have ever qualified. Nike is 1 year away. The current quarterly dividend is 41 cents per share. That's $1.64 annualized. At today's stock price around $43, that's a yield of roughly 3.8%. You're getting paid nearly 4% annually just to wait for the recovery, on a stock that most analysts think is worth 50% more than where it's trading today. And that dividend has never been cut, not once. Through all of this, that's not nothing. That's a 24-year commitment that Nike has kept during circumstances that would have broken most companies. Now let's be honest about what can go wrong, because this isn't a clean story and I'm not going to pretend it is. China is the most serious issue on the board. Nike just reported 7 consecutive quarters of declining revenue in China, which is a massive market. And for the current quarter, the company guided China sales down another 20%. Greater China used to contribute over $7 billion annually to Nike's top line. That engine is not recovering on any near-term timeline. Tariffs are a structural headwind. US tariff policy compressed Nike's gross margin by roughly 300 basis points in the most recent quarter alone. The company is currently running at a 40% gross margin, well below its historical range of 44 to 46%. Until trade policy changes, this is real money coming out of every dollar Nike earns. Converse is a crisis that doesn't get enough attention. Revenue at the subsidiary fell 35% in the third quarter. The brand swung to a $40 million operating loss, and Nike has offered no public strategy for fixing it. And the timeline. Elliott Hill himself said the recovery will take time, and that marketplace cleanup headwinds will persist through fiscal 2027. This is not a quick swing trade. If you're buying Nike here, you need patience measured in years, not quarters. Those are the real risks. Don't let anyone, including me, skip past them. Let's talk about the competitive landscape, because this is where the narrative gets complicated. On Running is not a fad. The company has posted revenue growth north of 40% in recent quarters. Their market cap has grown to over $20 billion. A business that essentially didn't exist 15 years ago, built largely during the years that Nike took its eye off performance running. Hoka, owned by Deckers, has become the #1 or #2 running shoe in key demographic segments in the United States. They did it the same way On Running did, by going hard on performance at exactly the moment Nike went soft on it. Here's the important context though. Nike didn't lose these customers to better marketing. They lost them because they walked away. The DTC pivot meant pulling out of the retail environments where running shoe discovery happens. Competitors filled the void. The question now is whether Nike can reclaim that shelf space. Early wholesale numbers suggest they can, but the competition isn't standing still, and the brand rehabilitation in the running world is a multi-year effort. Here's what I keep coming back to when I look at this situation. On Running is hot. Hoka is hot, but they don't sign superstars like Ronaldo. Nike has the most recognizable sports brand on the planet. Not one of the most recognizable, the most. They've held that position for 4 consecutive decades through multiple market cycles, multiple cultural shifts, multiple competitive threats. The Jordan brand alone generates over $7 billion in annual revenue. By itself, Jordan would be one of the largest sportswear businesses in the world. Nike spends over $5 billion on marketing annually. For comparison, that number is more than the total revenue of most brands that are being positioned as Nike's killers. And the athlete relationships, the LeBrons, the Ronaldos, the Federers, these aren't just endorsements. They are cultural assets that took decades to build and cannot be replicated by writing a check. Nike is not a company that stumbled into relevance. It built it category by category, athlete by athlete over 50 years. One CEO's bad strategy doesn't erase that. The moat is still there. The question is whether the current leadership can translate it back into results. So let's look at the numbers. Nike's current price to earnings ratio is approximately 28 times. Nike's 10-year historical average PE is 37 times. That means on a relative basis, you are buying Nike at a 25% discount to what this company has historically traded for during a period where the recovery is already showing early signs of working. 26 Wall Street analysts cover this stock. Their consensus is buy. The average price target sits in the $63 to $67 range, from a current price of $43. That implies more than 50% upside if the analysts are right. And here's the thing about that 52-week high of $80. Nike doesn't need to recover to its all-time high for you to do well from here. A partial recovery to $65, a level the stock reached just last year, is still a 50% return from today's price. The market is currently pricing Nike as if the turnaround never happens. The insiders, the analysts, and the early data all suggest the market might be wrong. That is the tension at the heart of this case. So here's where I land. Broken business or broken stock? This is not a broken business. The brand is intact. The athlete relationships are intact. The distribution infrastructure is intact. The 24-year dividend streak is intact. What was broken was the strategy, a 5-year bet on direct-to-consumer that ignored the reality of how people actually shop for athletic goods. That strategy has been replaced. The person who replaced it spent 32 years building what that strategy tried to dismantle. And the insiders, the people with the most access to what is actually happening inside this company, have bought tens of millions of dollars of stock at these prices just in the last few months. None of that means Nike is a sure thing. China is a real problem. Tariffs are a real problem. The turnaround will take longer than most investors want. If you need this to work in 6 months, this is probably not the right investment for you. But if you're the kind of investor who buys a story before the crowd catches up to it, and you understand both sides of the argument, this is one of the more interesting setups in large cap consumer right now. The question isn't whether Nike is good or bad. The question is whether the market has it right. I don't think it does. Now, I want to hear where you land on this. Are you in the camp that says the brand damage is too deep and the competition has moved on for good? Or do you think this is exactly the kind of setup that gets rewarded a year from now? Drop your take in the comments, and if you found this useful, subscribe to the Pitch Desk. Every video is a case like this. We pick a company stock, do the actual work, and give you both sides of the argument so you can form your own view. No noise, no filler, no recycled takes. See you on the next one.